Hi, today we're taking a look at market-based valuation, an alternative and in some places a complement to using some of the other methods that we've looked at, like the dividend growth models, the free cash flow models, and the residual income models. You can see that when we look at a series or a typology of methods, the type of methods we can choose will involve either relative valuation models that we're going to look at today, or some of the other methods that we've looked at earlier. Understanding the asset-based value of a business is simply the accounting approach, and we've considered that in other parts of our program. In this course, we've looked at present value models, including dividend discount models, a couple of free cash flow models, and the residual income model in our previous session. Today we're going to take a look at some of the other methods, the relative valuation models, price earnings models, enterprise value multiples, market to book value, price to cash flow, price to sales ratios, a very long list of other possible methods. And you'll see that these are all going to be parts of a toolkit. And in this session, we'll not only tell you how to use these and how to calculate them, but how to develop the judgment to know where to apply them. Today's session we're going to take a look and compare the different methods, including the economic rationale for each. We'll calculate and interpret price earnings multiples, but also alternative multiples and other methods like dividend yield. We'll look at the rationale for using the alternative multiples. We'll calculate and interpret ways of understanding the underlying earnings for a business, and explain the methods for using a normalized earnings per share number in order to adjust some of those alternative methods. We'll take a look at the inverse of the price earnings multiple, the earnings yield, or earnings divided by price. We'll calculate and interpret our justified price earnings ratio, price to book ratio, and price to sales. And we'll finish up by taking a look at how we can predict the price earnings multiples. One of the reasons why relative valuation is relevant is that we know that the value of a business is going to be based on its current valuation based on the future cash flows to our investment today. But we also know that some businesses are either growing faster or slower than the economy in which they operate. And that's where momentum becomes a factor. In other words, once a stock is moving in a particular direction, the chances are better than average that that stock will continue to move in that direction. A fast growing stock will continue to be a faster growing stock, or a stock that sees its earnings growing more slowly will more likely see its earnings continue to grow more slowly. And that's what momentum is about. Comparables are just a general way that we value many things, trying to understand that the value is going to depend on what the company grows like. If we're valuing certain types of business, we know there are standard multiples or standard methods that are often used. For example, if you wanted to buy a car dealership, and a great example of this is the Wheaton businesses that you see all over Western Canada. That business was essentially built up by the Wheaton family from Edmonton, who traveled around Western Canada in their jet. They would fly into a medium-sized community, take a look at a General Motors or a Chevrolet dealership, and essentially their pricing formula when they made their offer was to pay 1.1 times the sales plus the value of real estate. And so you could pretty much guess as they came into town how much they were going to offer for your business. And if you could do better than that, well, obviously you wouldn't accept the 1.1 offer. But that was their multiple. And it was interesting later on when I looked at the sale of automobile companies that they tended to sell. When one auto company was bought up by another auto company, they also tended to sell for about 1.1 times their average 3 or 4 years previous sales. Another good example was one that I saw when I was an MBA student. One of our graduates from that MBA program had, when he graduated, decided he didn't want to take a job in a bank or in investments. He wanted to build his own business. Well, he didn't really want to build his own business. He wanted to buy his own business. And he did. He bought a tool rental company. And then he bought another tool rental company and another tool rental company. Mostly these were small ma and pa type businesses that would operate within a confined geographic area. And by bringing them together, he found that he could reduce the amount of tools that he had to own, because he could move them from one place to another within his business. He could also get higher value-added tools that would cost more, but they would be centrally located and they would be shipped out to construction sites, like excavators and backhoes and things like that. He also could reduce the cost of maintenance, and he could source the tools that he rented much cheaper because he had buying power. So once he got 4, 5, 6, 7, 8, 9, 10 of these locations that he'd bought up, he started to develop a common brand and created a bigger umbrella business. So that 10 years after graduating from his MBA program, he'd built a company that was of not quite national scale, but certainly of regional scale. And he essentially sold out himself at that point, made I don't know if it was a large fortune, but he certainly made a fortune from this process of acquisition. Now, the way that he described to us as MBA students how this worked was that he would go into a business and offer about 3 times the previous year's cash flow. He was using a very simple cash flow multiple in order to value the business. The logic behind that was that he could earn back the value of the business from its own cash flow within 3 years. 4 years would be too long, 2 years would be too ambitious. And that was his multiple, or his model. Very simple way of valuing a business. And so we see elements of that when we're trying to value companies. We have seen how we can use things like the discounted cash flow and the dividend growth model to value businesses, or to at least establish the intrinsic value of those businesses. And those values and valuation systems had in common that they worked on the basis of the expected return to the asset, plus the present value of the growth opportunities. And that's essentially our justification of that value based on a multiple, or the justified price multiple. Justified price to sales, price to book, price to earnings, or whatever it is. Essentially, if 20 times is your price earnings multiple, and it's 20 times earnings, if you know that your earnings are $1, 20 times $1 of earnings puts an intrinsic or inherent value on that business at $20. And you can apply that to several different methods. A good example comes from Gordon's growth model, or the dividend growth model. Essentially, it says that the price earnings multiple is going to be determined by the present value of the growth opportunities plus the expected level of yield. So if we see, for example, that we have a cost of equity, R, is 10%. We know that in this case, that our discount rate of 10% gives us essentially a standard multiplier for a no-growth company of 10 times. So if we see that this is a 20 times price earnings multiple, then we know that the present value of the growth opportunities have to be some kind of a multiple of 10. So we're getting 10 for the yield and 10 for the growth. And if we had a $1 earnings per share, then the present value of the growth opportunity per share must also be 10 times. So this is a way of understanding the contribution of yield and also of growth. Now, price earnings ratios are the most commonly cited statistic, perhaps after earnings per share. So if we see that a company has a 20 times price earnings multiple, we'd say that sounds about right. Today, the average price earnings multiple for a Standard & Poor's 500 company is about 18.8 times. Well, 20 times, pretty close to that. If the price earnings multiple is 100 times, you'd say that company either sounds really expensive or it's got great growth potential. But there are a number of things that we need to understand. First, a couple of standard problems in interpreting the price earnings multiple. One of them is just simply a matter of timing. It's a problem of comparing the time in which we observe the earnings per share, the historical period, versus the time in which we expect to earn the price, the present value of those growth opportunities in the future. There are a number of other problems that we describe as the EPS problem, and I'll come to those in just a moment. Essentially, the problem of timing is a standard problem of calculation. We are using the earnings per share from last year, or at least in a standard trailing price earnings multiple. We use last year's earnings. And last year's earnings could have been great or they could have been terrible. That may reflect on the future value, but sometimes there's a good reason why earnings in the past were low. For example, a company that's growing quickly is reinvesting a lot of money into R&D that might be expensed and training costs, and it's inefficient because it's in a high growth stage of development. So the earnings per share could be really small or they could be negative. That could be a problem. The price that we see, or the share price, is an indicator of the present value of the future cash flows, and the future might look great. So if we're comparing the future to the past, we have a problem of timing. You're standing in the middle, you're looking backwards on half of the ratio and forwards on the other half. And what you're seeing may be an indicator of value, but it could also be a problem of timing. We can perhaps get around that by using forecast earnings instead of historical earnings, and we call that a leading price earnings multiple. Of course, if we're using historical information, we're using a trailing price earnings multiple. Sometimes that's based on last fiscal year's earnings per share, and sometimes it's based on the trailing 12 months, and I'll come back to that one in a second. Another alternative would be to take the earnings per share and standardize or normalize them by changing the earnings per share to what they would be in a normal situation. Essentially taking a long run average earnings per share and using that in the denominator. Here we can see an example of where we would have that kind of problem. The earnings per share for Tesla have been, and I think with one brief exception, one quarterly exception in the past, these numbers have always been negative. If we take our historical numbers, which are shown here as the orange bars in this chart from the NASDAQ website, the earnings per share are negative, right up to the time on which I downloaded this in 2018. And even the forecast earnings per share are still going to be negative. The forecast, or consensus forecast, is based on a number of different analysts who've written brokers' reports, and in the brokers' reports, they've predicted what the earnings per share will be, they believe. Now, one analyst could be ridiculously wrong, but if we get 20 analysts from different investment banks who are all following this company, the average is going to be perhaps not perfect, but it'll be more reliable. So consensus earnings per share might be an improvement, but in this case, not so much. Price earnings multiple generally doesn't make sense when we're using negative EPS stocks, but it becomes even worse if the earnings per share gets very close to zero, because the price earnings multiple becomes incredibly large and sometimes approaches infinity. So if we have 1,000 times or a 10,000 times price earnings multiple, it's probably not because the share price is really high, but because the earnings per share is very close to zero. There are also a number of issues with the accounting information that's used to create the earnings per share. Several steps in the production of the company's accounts, managers make choices, and those choices are going to affect the annual reporting of the earnings per share. So if we decide, for example, to not report certain expenses as part of our earnings per share because they're considered to be non-recurring, that could distort the earnings per share. That's where we have interesting terms and issues, like what do we mean by a recurring or a non-recurring expense? Is a bad debt going to be non-recurring? Well, not if you have a bad debt every year. That would just be unfortunate. It would be perhaps extraordinary, but it would not be exceptional. And so those kind of terms that are defined within the accounting rules are going to be part of our calculation of the earnings per share. We might also have a problem if we are going to do acquisitions, and instead of using our cash and calling those acquisitions a part of our costs, yet we're going to issue shares, and those shares are going to increase the per share. So the earnings may be divided by more shares, reducing the earnings per share, not because the company's operations were weak, but because the number of shares have increased. We might also have problems with accounting policies, changes to accounting policies, and adjustments within our observation of those accounting policies. And that's when we start to bring in terms like basic and diluted earnings per share. And essentially, dilution is a term that becomes important if the company's number of shares outstanding increases. And often this happens regularly because companies issue stock options to their senior managers. That increases the number of shares unless the company buys them back on the open market. Perhaps there's an employee share ownership scheme that requires the increase in number of shares. Perhaps we have convertible preference shares that can convert from preferred shares to common shares, or warrants that have been issued. In all those cases, the number of shares could increase. In this particular example, from the equity markets textbook, we see that in this number 2000 and 2007, WPP, which is an advertising and public relations firm, one of the world's biggest, reported its earnings per share of £39.60 and diluted earnings per share of £38. With a closing price of $596.5, and that number doesn't change. On that day, its price earnings multiple would be calculated as that price that I just quoted divided by 39.6 and 15.7 if we use the diluted value of a diluted earnings per share of 38. So the price earnings multiple does change depending on how we report the earnings per share. We can also make adjustments based on both the observation of recurring versus non-recurring, and also the quarterly results. We can, instead of using the last fiscal year, the last 12 months, we can take the last 4 quarters. So here we've got a company, and this per company AZN, which I believe is AstraZeneca, a British company but traded on the New York Stock Exchange. We have a little bit more information. The share price was $41.95. And if we have a price earnings multiple based on the trailing 12 months. Now, we got that trailing 12 months by taking the last full year, which is 2007, and we're already into the second quarter. So in the second quarter, we're going to get the last 3 quarters of 2007 and the first quarter of 2008, which would be the last 4 quarters. We're going to subtract the first quarter of 2007 from the full year. So that's 374 minus 102. And then we're going to add to that the next 3 quarters. And the sum of the next 3 quarters results was 272. So we've got the 3 quarters of 2007 and the first quarter of 2008 give us 375. So 374 minus 102 gives us 272. Add 103 for the first quarter of 2008 gives us the last 4 quarters, and that was 375. On that basis, our price earnings multiple would be 41.95 divided by 375, which would give us 11.2. So that would be our price earnings multiple for the trailing 12 months. Now here you can see they've also quoted something called core earnings per share, and that has stripped out some non-recurring expenses. For example, if AstraZeneca decided to write off part of its business, close down part of its business and write off some of those assets, then they made an adjustment taking the earnings as if they didn't have that non-recurring expense. In this case, they had $4.38 from 2007. We subtract the last quarter the first quarter of information, first quarter earnings per share information, and that gives us 331 for the 3 quarters of 2007 that count. We add to that the $1.28 that they have for first quarter, and that gives us 459. So 459, the price over earnings per share. Still use the same price. And because we've got so much more for earnings, that gives us a much lower price earnings multiple of 9.1 times. Not nearly as high a number, perhaps suggesting that maybe we've undervalued the business. Now, they've also said that in these numbers we have some kind of an impairment. I don't know specifically what that is, but if they have some kind of a revenue stream that might perhaps be in the process of nationalization or subject to a large lawsuit, and they feel to be conservative, appropriately conservative, they're not going to count that revenue for now. You can see the full year 2007 was $3.74. They subtract from that the first quarter to count only the last 3 quarters, $2.72. Add to that the first quarter of 2008, $1.15. And now we have got, with the impairment, we've got $3.87 as our trailing 12 months earnings per share. $41.95 divided by $3.87, that would give us a 10.8. So a number someplace in the middle. So those are 3 different ways that we could report that one price earnings multiple and 3 different earnings per share, and we haven't yet even considered the effect of dilution. So perhaps 6 different ways of measuring the price earnings multiple. An alternative approach to this is to use a normalized price earnings multiple. And we see that this may become necessary, and we'll look at a couple of reasons for that now, but this could become necessary because of just the business cycle. The last 4 quarters might not reflect the long-term earning power of the business. And that's especially true for companies that are going to be subject to a lot of pressure from business cycles. Durable consumer goods, for example, are more volatile in a business cycle. So they tend to be better in the stronger part of the business cycle and worse in the worst part of the business cycle. Other businesses will be affected much less, like consumer goods companies like Unilever and Procter & Gamble. And so we need to be aware of the effect of the business cycle. In fact, we describe the effect of especially pro-cyclical businesses as being something called the Molodovsky effect. Now, this was something that was originally identified in 1953 by Nicholas Molodovsky, and he essentially said that trailing EPS for cyclical stocks are depressed at the bottom of a cycle and unusually high at the top of a cycle. So we have too high of a price earnings multiple at the beginning of a cycle and too low of a price earnings multiple at the top of a business cycle, especially for pro-cyclical businesses. Or if you look at this particular chart, as we're moving into recession and moving through recession, we'd expect to see a particularly high price earnings multiple for businesses at this stage, and as we get into the top, a lower price earnings multiple because we're overstating the earnings per share for our business in the top of the business cycle. And so we can adjust this by using a model to normalize it. And we'll look at a couple of methods of that. In this particular example, we're looking at a company called Taiwan Semiconductor, and we have 7 years worth of information for their earnings per share. There's a certain amount of volatility in their earnings per share. In 2001, earnings per share is very low. Well, we remember 2001 we had the dot-com bubble, and the world economy was not doing terribly well. So 2001, 2002, very low. By the time we get into 2005, 2006, the earnings per share is doing so much better. If we want to ignore the volatility or the uncertainty of those earnings per share and just say, what does an average year look like? We could take the sum of those 7 years' earnings per share and divide them by 7. So we see that the average, our average earnings per share would be about 43 cents. That's our average. And we can use the average to calculate the price earnings multiple. So if our price, and the price is missing from this, so the price of the company today, $10.01. And these are not shares, but these are ADRs that are traded on the New York Stock Exchange. So if I wanted to know what my price earnings multiple, 10.01 divided by 43 cents. This company is trading at a price earnings multiple with normalized price earnings multiple of 23.3. And that would be the number that we'd expect to see in the long term. We can also do an alternative calculation of this using the rate of return on equity and the book value per share, or the net asset value per share. And we can see that the average rate of return on equity for the company over all of this period would be the sum of all of those numbers in this row, sum of the 7 numbers, divided by 7, and that's 16.63%. That's the average ROE. I'm on the wrong line here, but you get the idea. So that's the ROE, which is quite volatile also over that period. And our book value per share at the end of the period, so we multiply that by $3.34. That says that my earnings per share would be 55 cents. So that's another way of normalizing the earnings per share. And so that means that if we have the same share price, 10.01, over the normalized share price of 55 cents, that gives us a multiple of 18.2 times. Two alternative ways of calculating the earnings per share, two alternative ways of adjusting the price earnings multiple. Another very famous way of understanding the price earnings multiple was popularized by Robert Shiller. Robert Shiller is probably more famous for predicting the overvaluation of markets in 2001. In fact, he wrote a very well-timed book called Irrational Exuberance, which essentially said that the stock market was subject to kind of the opposite of panics, irrational exuberance, people buying when they shouldn't be buying. And one of the things that he proposed to help us to avoid this, to help us to recognize when markets were overbought, when everybody's trying to buy in and they're pushing up the share prices of common stocks like Google's and Apple's and Amazon's. He said we should use a special price earnings multiple, or a PE10, or the CAPE ratio, and use that to smooth real earnings, to eliminate the fluctuations that are caused by variations in profit margins during certain points in the business cycle. This is described, or is known as, the cyclically adjusted price earnings multiple ratio, or the CAPE ratio, and it takes the average inflation adjusted earnings from the previous 10 years, and that's why we call it the CAPE PE10. So here we're just adjusting or averaging the earnings over the last 10 years. And you can see that with this information, the top line represents the movements in the market. And in the long term, you can see that the markets do tend to be upward trending. That's not unusual, but we don't expect to see the price earnings multiple to be upward trending, because earnings should be growing along with the value of the business. In an overbought market, as we saw in 2001, we could have a very high price earnings multiple of 44 times. Clearly, again, using the PE10 ratio with the cyclically adjusted earnings per share, that's a significantly overbought market, and it's definitely ready for a collapse, which is exactly what happened in 2001 when people pulled their money out of the market or moved their money into safer investments. When we see lows in the market, when perhaps the market is oversold, like in the mid-1980s at six times, or in the beginning of the 1920s at 4.8 times, then that's a general buying indication, suggests that this is a good time to get into the market. Right now, we're looking at an average price earnings multiple of below 20 times. Now, price earnings multiples, as we mentioned earlier, can be a problem when they become negative. We can't calculate them. If we're looking at some of the numbers on this chart, from this example again from the equity markets textbook, companies like Molson Coors, we can use a trailing price earnings multiple based on the price and the earnings per share, comes up with 19.9 times, and that's fine. If we try to calculate Boston Beer, that's even better, 44 times. How about if we try to calculate some of these others, ones that are perhaps not quite so famous and perhaps at an earlier stage in their growth? They have negative earnings per share. For example, Pyramid Breweries at the bottom of the table has a negative earnings per share of 42 cents per share loss. $2.57 divided by a negative number. Well, by convention, we don't report those as negative price earnings multiples. Instead, they just put NM, or not material. An alternative way of looking at that, instead of having the price earnings multiple, let's take the reciprocal and we'll have the earnings over the price multiple. Well, not multiple, percentage. And that number is essentially the capitalization rate, the rate at which capital reproduces itself. For Molson Coors, with a 20 times price earnings multiple, 2.9 divided by 57.72, the earnings over the price, will give us a 5% earnings to price ratio, or capitalization rate. And that number essentially is a reasonable rate of return. It tells us that we're getting a 5% rate of return based on the return to the basic capital and the return to growth. Anheuser-Busch, 4.6%. That's fine too. By the time we get to the bottom of the list, what we're seeing is that Pyramid Breweries is essentially consuming capital at a rate of 16% per year. And so that number is still meaningful. It's just an unhappy number. So a negative number makes more sense if we're taking a look at the capitalization rate. It doesn't make sense when we're looking at the price earnings multiple. And as you get to a really, really small number, it still makes sense because that number goes to zero. So it's an alternative way of using an inverse ratio. And there are other methods that we may use. Some of them are more commonly used than others. Price earnings and the capitalization rate, or the earnings yield, they're commonly used. Price to book value and book to price value, or book to market value, less commonly used, but also can be used. Price to sales, or sales to price. I've never really seen this used commonly, but it's also possible. The price to cash flow and the price to dividends yield, both types are used. In fact, the dividends over price is more commonly used than price to dividends. So they can all be used as alternatives. Price earnings can also be used when we're calculating the terminal value. You remember the difficulty that we had in a course like MBA 521 of calculating the value of the business after our forecast horizon. So we had to calculate the terminal value, and we had this very complicated formula, which was also problematic because quite often the free cash flow in the last period of our forecast period was the number that we trusted the least, and it created a lot of the value for the company. So as a result, a lot of valuation specialists, when they're doing the valuation, will use the forecast window free cash flows. And then at the end of that period, they'll use a price earnings multiple, or a market to book value number, or perhaps a price to cash flow number, but they'll use some kind of a multiple in order to value the terminal value. So, for example, if we have an industry median or average price earnings multiple, which we trust, that number could be used as part of our equation. We could take the average of our own price earnings multiples, we could use forecast price earnings multiples, and the way that would work was we would take the price earnings multiple that we recognize and multiply that by our forecast earnings per share in the last period. So, for example, if we have a company that's got a 30 times price earnings multiple, and that's the average or the industry average that we decided to use, and we have a $1 earnings per share forecast for year 5 of our forecast. That means that the value of our cash flows would be 30. If this is $1 million, it would be $30 million. And so the earnings per share in dollar value times the price earnings multiple becomes the value of the cash flow that would be assumed received in that last period. We discount that back to the present to figure out what its contribution to the present value of the company would be. So you could use this as well: price earnings, price to book value, price to sales, price to cash flow. Several alternative ways of using it. Now, price to book value is something that we've already seen as well. We talk about the market to book value, the price to book value, and this is something that we tend to feel more comfortable with because the book value or the accounting value of the business tends to be more stable. The information is supported by physical assets and a history of earning, and that's going to be more reliable when the future is more uncertain and earnings per share is less predictable. It's also good for valuing businesses that are built up of good tangible assets, like the money in an investment firm, an insurance company, or a bank. It unfortunately misses out on some of the contribution of those intangibles, the things that are created by human efforts. So human capital may be understated with this approach. And it may be misleading when we're trying to compare it with firms with different business models, and I'll show you an example of that in just a minute. There may be a lot of accounting issues that are built into this. For example, if we're comparing British and US companies or Japanese companies, the IFRS approach versus the US GAAP or Japanese GAAP approach might give us very different valuations. There may be different adjustments for goodwill, impairments. Pensions are often valued very differently in different accounting standards and pension obligations. So those things may give us a very different book value for the firm. We may also see that things like inflation may understate the value of assets that have been bought in the past, and technological change may help us to overstate the value of some of those assets we bought in the past. And on the per share front, share repurchases and either writing off or carrying forward those shares on the books can distort our view of the trend. Now, this is a good example of how business models are reflected in price to book value ratios. We've referred to Dell quite a few times, and Dell is a company that's become, or has pretty much always been, famous because it does things differently. It does a lot of its marketing online, or historically it has, and it doesn't maintain large inventories. Most of its product is produced by other companies, and so it doesn't really look like the rest of its peer group. And you can see that here from their price to book value ratio. Dell has a much higher, or had at the time this example was used, had a very high price to book value multiple of 10 times. It was doing very well in the market because of its perceived cost advantages, but also the book value of its assets were a lot smaller because it didn't have to own factories and it didn't have to own inventories all it owned was a website. And so that gave it a much higher price to book value than the mean and the median values for its industry. Another commonly used multiple is the price to sales ratio. It can be used to value private companies, and as the example of auto dealerships that I used earlier highlights, it's often used to value private companies. It can also be used to value public companies, and that's going to become especially more relevant in businesses where the earnings per share can be negative. Even the free cash flows, even the operating profits could be negative. So sales are always going to be, well, not always, usually going to be positive. So we can usually use a price to sales multiple, even if all of the other numbers are negative. Some of the downsides or the drawbacks, a company can have growth in sales without producing any kind of meaningful profits. The price is partly produced by leverage, so a highly leveraged business will be valued without any kind of information about that degree of leverage included in the valuation. It doesn't suggest or discount the possibility of having more efficient production and better cost structures. And revenue recognition practices of companies may also distort the price to sales. If a company is, for example, with Enron, when they were recognizing contracts as being equal to sales, a contract that is for 10 years into the future might list sales that are not really this year's sales as part of this year's sales figure. Now, we've introduced the idea earlier of a justified ratio, and essentially a justified ratio is when the value indicates true intrinsic value. In other words, if we have a company that has got a 10 times price earnings multiple, and we have earnings per share of $1, then 10 times $1 suggests that the inherent or intrinsic value of that business is 10 times $1. In this case, we can use a price to sales ratio to get essentially the same effect. Here we have a company called GETI, or Getty, this is their ticker symbol, a Swedish company, and we have reporting in Swedish krona. The company's sales per share are forecast at 64.4 Swedish krona. And from this, we want to be able to determine the justified price to sales, the intrinsic value of the stock, and to state whether or not we think the stock is fairly valued, overvalued, or undervalued. To go back to part one, calculate the justified price to sales ratio. Well, the price to sales ratio is essentially the profit margin, the earnings over sales, times the payout ratio, or the plowback ratio in this case, treated as a perpetuity. So for GETI, they had an 8.2% profit margin. Whatever their earnings divided by their sales was gives us 0.082 as their profit margin. They paid out 70%. So B was the payout ratio, and 1 minus B is the plowback ratio, or the retention in the business. So 30% of that 8% was retained in the business, and it's increasing on an annual basis at a rate of 10%. So we gross that up for growth by multiplying it by 1 plus the growth rate. The discount rate, or the cost of equity in this case, was 11%, and the growth rate was 10%. So that numerator we just calculated divided by 1% gives us a price to sales ratio indicated of 2.7 times. Now the price to sales ratio of 2.7 times the predicted sales. So we have 2.7 times the predicted sales of 64.40 gives us a valuation of Swedish krona 173.88. The actual quoted price on the stock is 138, and that's a lot lower than our predicted 178 and 173, and so we'd say that it appears to be undervalued, and yes, you should buy it. So that's using a price to sales multiple in order to value the business. Now, we also have price to cash flow and variations on price to cash flow, and we'll look at a couple of those next. This is based on the logic that cash is king. Well, it's harder to lie with cash, or at least cash was historically less likely to be manipulated, partly because we didn't report it. And then in the 1990s, we did start to include cash flow statements in our accounts, and analysts looked more carefully at the cash flows. And they said it's less likely to be manipulated than earnings. Well, it was true, but it's not really the end, quite the end of the story. So it addresses some of the problems of accounting practice and the differences in accounting practice between companies. It ignores some of the non-cash revenues and expenses. It takes out the effect of changes in working capital. Historically, and the theory has suggested that it's more like free cash flow. It's more of an appropriate measure because it's equivalent to free cash flow. And the theory supports the use of free cash flow rather than using the operating cash flows from the income statement. That's partly because when people start using the operating cash flows from the cash flow statement, companies start to try to manipulate that one particular number. Instead of cash flow, we can also use the operating profit. So operating cash flow or cash from operations, we can use the EBITDA, and we see that in multiples like the price to EBITDA and the enterprise value to EBITDA. And we can use adjustments as well to that. A couple of other measures that we're likely to use, dividends and dividend yields. Dividend yield is going to be part of the total return. Remember, our return comes from capital gain plus the dividend yield, and the dividend yield is the part that we can verify, we can justify. The other part is part of our question. Do we justify, or can we justify the share price? That's part of our capital gain. So yes, dividends are part of the total return, and they're also less risky than waiting for the capital appreciation. On the negative side, we're only using part of the information on the dividend yield side, and we're ignoring growth. And growth might be the most important part of the value of the business. So by focusing on dividends, investors may be trading off future earnings for higher dividend yields. And here you can see a great example of this. From the textbook example, we have 4 companies that are all in the electric utility business. The ones with the highest growth forecasts are, well, at the bottom of the table mostly. We have PPL, which is a Pittsburgh-based electricity utility. The lowest growth is Progress Energy. Progress Energy also has the lowest beta, but it has the highest yield. 5.9% gives it by far the most attractive yield. It's also paying out a large percentage of its earnings. So its yield is a result of high payouts, and is at a cost to growth, because if you give all of the money back to the shareholders, you haven't got money to create that growth. That may explain the lower consensus growth forecast. Our lowest yielding company is that last one, PPL. It's got a low payout ratio, a low dividend yield. It actually has the lowest beta, which may be attractive, but it has the highest growth forecast. And so that suggests that this company might be the best value, because even though it has the lowest yield, the combination of growth and yield combined is just about 20%, compared to the growth and yield for Progress Energy, which is closer to 12%. Another important tool that we use, a very important part of our toolkit, is to use a multiple of enterprise value. One of the most commonly cited measures of valuation is the EV to EBITDA multiple. But there are a number of other alternatives. Enterprise value to free cash flow to the firm, enterprise value to EBITDAR, including rent, enterprise value to sales are all going to be other alternatives. And for all of these in common, the numerator is the sum of the company's market cap, all of its debt, preferred shares, and equity, at market value, if possible, are used in the numerator. So that's essentially the entire value of the enterprise. The lower the EBITDA, the more attractive the investments. And so often we'll see things like bargain stocks with attractive EV to EBITDA ratios, essentially saying these are companies that are probably underpriced. Because the enterprise value equals all of the equity values for common and preferred, plus the debt, EV multiples are calculating using denominators that are going to be relevant to all the stakeholders. So we're not just looking at the returns to the equity, we're looking at the returns to everybody. And that's where EBITDA is used in the denominator. It can also be used for a company that has negative net income or negative earnings per share, because quite often operating profits, especially after adding back depreciation, will typically be a positive number. But it can also be used for companies with negative EBITDA. For industries with very high investment requirements, and in other words, very large amounts of depreciation, like telecom, those may work better. This may be more useful than using a price-earnings multiple. And it also allows you to value companies with different amounts of leverage, because it's all going to be held within the valuation model. It's useful for comparing companies within a peer group or within an industry. An alternative is to use EV to sales, and we see this in certain industries where, in some cases, several firms within that industry have negative EBITDA. And if that's the case, then the multiples may not work so well. So in that case, we're more likely to use enterprise value to sales. And because sales is almost always going to be a positive number, it allows us to use or to calculate the valuation of companies whose operating costs still exceed revenues. Another interesting valuation tool that we use is the PEG ratio. Essentially, it's an extension of the price-earnings multiple. It is the ratio of the price-earnings ratio to the forecast or the expected growth in its earnings. A company with a low PEG ratio indicates low value because, well, either because the company is a bargain or maybe just because the company is bad, it's a dog. A value of 1 would represent a fair trade-off of the cost of the stock, the price of the stock, and the future value of the company's growth. Although that could be an oversimplification, but it's certainly a good place to start the analysis. And the PEG may be more useful as a relative valuation measure when you're comparing other companies in an industry. If you take an example here from NASDAQ, in the older version of their website, where they had this great graphic that I don't think anybody really understood, you can see that Netflix, at a price on the day when I downloaded this of $381 a share, had a PE to growth ratio of 4.78. Across the bottom here, we have a value of 1, which would represent a fair trade-off, where the growth is greater than the price earnings. And over here, the price earnings equal to growth, and over here, the price earnings is greater than growth. Well, clearly, this business is way over here on the right-hand side with a PE to G multiple of 4.78. Compare that now to companies like Amazon, which today had a PEG multiple of 5.5. So still, very heavily favored in terms of growth. Now, another method that we discuss also in our 521 course, and we'll finish up with this one today, is the price to book value, or the market to book value ratio. And in this case, which we also describe as Tobin's Q, we've mentioned this one before. If the value is greater than 1, the market value is greater than the replacement cost of the assets. And so the company must have been able to create, over time, certain type of intellectual property, has become a participant in network economies, has greater growth prospects, perhaps because of reputation, brand, customer relationships, that can't be reflected in the book value of its assets. It could also be caused because of inflation. And in some cases, we'll see that this is used to identify companies which might represent a bargain. And in this case, this article tells us that, take a look at these companies. They have a low Tobin's Q, or a low market to book value ratio, as low as 0.42. It suggests that the company's share price is only 42% of its asset value, the replacement value of the assets in the business. So if this company was made up of silver or gold, if those were its principal assets, unless something's wrong with their gold, there must be a reason, or perhaps this is just a plain old bargain at 42 cents on the dollar. Allied Nevada's 42 cents, or as we get to the other end of the list, Silvercore valued at 85 cents on the dollar. So anytime the market to book value ratio is below 1, it's either a bargain or a dog. So in summary, in this session we've said that along with other alternative and complementary methods of valuation like dividend growth models, free cash flow models, and residual income models, multiples can provide us with an alternative type of fundamental analysis. Things like price-earnings ratios and the justified price-earnings valuation that we saw earlier are important tools, but also other alternatives like the price-to-book value, price-to-cash flow are commonly used. And we looked at things like enterprise value and market-to-book value ratios, PEG ratios. The bottom line in all of this is that certain industry dynamics require us to be able to use several different alternative tools. And probably even more importantly, we have to develop the judgment to help us choose the right tools for the job.